Welcome to another week of The Educated Homebuyer Live with myself, Mr. Jeb Smith, and my esteemed colleague, Mr. Josh Lewis. We are here to update you on everything that's happening in the economy, the housing market, mortgage rates, really take you through it all, and more importantly, answer your questions. So, Josh, welcome to the show.
Should we start referring to each other as the like we're congressmen, like the distinguished gentleman from Huntington Beach will now take the floor? Now has the floor. Is that how, we're gonna figure it out. You gotta say the right thing, but I like. We'll go by the distinguished gentleman.
I like just Mr. Josh. I'm just gonna call you Mr. Josh. As a kid, I had to call every person that was essentially older than me Mr. somebody. And
you would just make up a name?
No, I mean, I had to call them, whoever I was introduced to, they were then Mr. So-and-so. And so, my friends' parents are still Mr. and Mrs. So-and-so to me. I don't call them by their first name. And I kind of struggle with that a little bit, Josh, because my kids now are at the age where they're calling adults by their first name. And I'm like, do I allow that? Or because the adults don't care. But where I'm from, the adults did care. And so when they go back, they're calling these people, it's a long story. This has nothing to do with housing, by the way. Just,
what I think is more important, Jeb, is that the last time I saw your oldest son, he threw his shoe at me. So
I mean, it was probably deserved.
I don't get a Mr. Josh or anything. I get a shoe thrown at me.
Well, that is probably deserved. So with that, guys, we are here to talk about housing, update you on everything that's happening, like I said, in the economy. But while we're doing that, please start by putting where you're watching from in the chat. Also, let us know your questions. If you have a question, start putting it in the chat now. We kind of go in order, sequential order. So the earlier you put it in theory, the earlier you'll hear your answer on that question. But let's, Josh, take a look at inventory. Inventory is something that we continue to watch week over week. And right now, we actually have 27% more homes on the market than we did the same week last year, sitting at 707,000 single family homes on the market at the moment. And the belief is that most of the dip from the holiday week's actually going to show up in next week's report. So at the moment, inventory is still dipping, but we're likely to see a larger decrease next week. And we're only 18% fewer homes on the market than we were in 2019. So we're above where we were last year, but we're still below 2019, as we've discussed many, many times. And with that, Josh, you can see that we went from 719,000 homes to 707 roughly. As we mentioned, the peak now is at that 739 number. And then that takes us into new listings, or actually takes us into here in Orange County. So Orange County sitting at 3,031 homes on the market. We're down 3.83% week over week. So from last week, and then down just less than 1% here in Huntington Beach at 208 homes on the market. As we know, the peak is in. Question is, where will things continue to go from here? So new listings data, 52,000 new listings this week. Again, the idea is that we're going to see a bigger hit next week with the holiday week coming this past week in how the numbers are actually reported. New contracts pending, sitting at 54,000 new contracts for single family homes this week, just above the 54,000 recent average. So we're just above where the average has been recently. And then if we look at pending, total pending, so that was new pending, total pending is just over 317,000 homes in contract, up 7% more than last year, same time last year. So we still have more homes under contract. Rates a little less than they were this time last year, Josh. Early December, we saw the peak in October, November last year. This time last year, rates are about the same where they are right now, somewhere in the mid sixes.
But they were dropping rather rapidly. And last Christmas, I gave you my heart. Last Christmas was when we saw that excessive exuberance and kind of got lower than we probably should have last year. We had hit, I believe, we got into the very low sixes, high fives through Christmas holidays last year. So that's right now about the same, but the drop was accelerating last year, and we'll see if it repeats itself again this year.
Because I stopped singing because nobody wanted to hear that.
No.
So just so you know, median price of new contracts. So the median price is sitting at $389,900. The median price of newly listed also at 389,900. And most of the measures of home prices have the year ending up somewhere around 5% for this year when it comes to price growth. Percent of properties with price reductions essentially moving sideways, if you will. We're sitting at 38.9% of the homes on the market taking some sort of price cut. So we know the average is somewhere between 30 and 33%. So we're above that average. But for the time of the year, you know, if somebody wants to get something sold, that's essentially what they have to do if they're keeping it on the market. So GDP, Josh, what are we looking at with GDP?
Spending as a percentage of GDP, the green line is defense. So when we talk about DOGE in the Department of Government Efficiency and Vivek and Elon going after inefficiencies. One of the things kind of off the table. Most people are like, no, we're not cutting defense spending, but you can see defense spending as a percentage of GDP has been decreasing. And what we have seen aggressively since the turn up in rates post-COVID is net interest on the government debt is going up. And the dotted lines are projections going forward. So we just crossed over where we're paying more on interest than on our national defense. So you guys probably are tired of me saying this and feel like I'm a broken record, but it is now becoming a national security issue that we have excessive debt and high interest on our debt. So I'll leave it there, leave it with what it is. So a similar looking chart here, similar source for the chart, but U.S. mortgages by interest rate. So right now that blue line had peaked up there at like 35% of loans were under 3%. And that number is coming down. So what that tells us is people are selling or refinancing out of, more likely selling their homes with those sub 3% interest rates. And we have more people buying or refinancing into rates over 6%. So you look at those jaws closing on that chart, it tells us that in the next couple of years, 1 to 2 years, we're probably going to have more 6% loans on the book than we have 3% and below loans on the books. So the lock-in effect should be decreasing over time. But what I would say, a theory, a hypothesis, is that those that are keeping them are more locked in, more committed to keeping those interest rates than those that are getting out of them now earlier. It's
interesting, Josh, that you say that. I have conversations with clients, friends that have low interest rates, and I vividly remember someone that I just talked to this past week saying, dude, I got a 2.5% on this thing. I'm never selling it. This week he reached out and he was like, hey,
I need to sell.
What do you realistically think my house is worth? And I'm like, hey, this. And so his whole thing is, I would do it if I could find the right house at the right price point. Now he's obviously in a more of a luxury price point, so it's a little bit different game. But the reality is the mindset starting to shift now with people in the house no longer being the perfect situation. It's like, am I willing to sacrifice some over here to get more of what I need over here? So, yeah.
It's definitely, it'll be interesting to see how it plays out over time. This chart sort of caught me off guard. I wouldn't have thought that they were coming together that quickly. This one here, Jeb, may have been only interesting to me. We recorded the episode of the podcast this morning where we're talking about Trump's policies and how they will impact interest rates in 2025. One of those things is immigration. And this chart here shows, the darker the green shows more people from that country in the US versus those in the US in that country. So if you look, Australia is the only place that has more Americans than we have Australians. But again, interesting, maybe only to me, but it shows you Canada and Mexico and parts of South America are where we have the biggest populations here in the US, and we'll see what that impacts migration. And we're generally talking about legal migration here from that perspective. So Jeb, this week is all about labor week here. Yesterday we had the JOLTS. As you can see, back 2022-ish is when these numbers were frightening to the Fed and to the government, that we had lots of job openings and very low unemployment. So not a lot of people to fill them. The fear was we would have wage-based inflation. So the gray line there is the openings rate, the job openings. And you can't really see, this chart is small, but we did a little bit of an uptick. It wasn't necessarily unexpected. We had a big drop in JOLTS last month, and it kind of came back more in line with that trend, but definitely trending down, up month over month. The hiring rate continues to be down, and the quits rate actually increased a little bit this month. So it'll be interesting to watch that over time. The market kind of shook it off in that it fits the larger narrative of moving more towards normality in the jobs market and not having that wage-based inflation. Today, we got the ADP numbers. ADP was lower than expected, but it wasn't a huge bit. So they were expecting 150. We got 146,000 new jobs last month. Last month was revised down to 184, and I think it was a decent sized revision. I think they were in the low twos and got down or revised down to 184. Interestingly, or maybe not, the service producing sector added 140,000 jobs. Goods producing sector only 6,000 of those jobs. So when we look at that, what's it telling us? Almost all of the inflation that we're seeing in the economy is in services, and it's wage-based. So that's where the jobs are. That's where people are going. They're getting paid, and it's translating into the cost that you're paying for a lot of things. The negative news in this one today, Jeb, was that annual pay gains for job stayers, so people staying on their job, increased for the first time in 25 months, up to 4.8%. And for people changing jobs, their pay increase went up to 7.2%. That has been moderating and normalizing, and the government has liked seeing that, not because they don't want you to make money, but that's so far above trend that, again, it's inflationary. We also got this morning, and this was more of the good news, sort of offset a little bit of strength in the ADP report that wasn't expected. The ISM Services Purchasing Managers Index. So the interesting thing here, declined to 52.1 from 56 in October, and it was way below forecasts. But the important part here is the employment component of that dropped to 51.5 from 53. So again, showing weakening in employment, and that is what the Fed is wanting to see, just a little bit. That Goldilocks is what they're looking for. They don't want you to lose your job, but they don't want that ultra tight labor market. The other thing that really helped in here, buried in that report, is price pressures increased slightly from 58.2 versus 58.1. So just showing, again, prices paid moderating there and not being super problematic. So what does that leave us? Target rate probabilities for the Fed meeting next month, 77% chance that we'll get another 0.25%, 22% chance that they leave it where it is. Jeb, talked to a listener to the show this week that had reached out, and they were, I want to say Oklahoma, Arkansas, somewhere like that. And they're dealing with their bank, and their bank said, oh, you don't want to lock in. The rates are going to go down on December 18th. If you haven't watched it, I believe we did an entire episode on this, Jeb, that Fed cuts do not equal mortgage rate cuts. So if you're talking to someone and they're telling you a specific date, whenever I hear that, I can just go to my calendar and look up and know that someone is referencing a Fed meeting and saying, you want to wait to lock because of Fed cut. Generally, that is the wrong information. More importantly, Jeb, on the probabilities here, we can see we're looking at a 65% chance that if we get this cut this month, that we're not going to have a cut in January, one more cut there either in March or May, and then one last one around June. And they're projecting at this point, the Fed funds futures market is that rates will stay level throughout the rest of the year, at least in terms of the Fed funds rate. So we'll see how that changes over time. You guys know how volatile this is. Interestingly, Jeb, whenever we talk about the key role that interest rates play in affordability and therefore sales volume, the reason why sales volumes are down are because interest rates are high, and we're having a big issue with that. People will say, well, it's a money supply is what dictates sales volumes and applications. This is a pretty clear chart. This shows the yellow line there tells you what the going 30-year fixed interest rate is, and then the blue bar at the bottom, or the blue blob there, shows you how many loan applications were that week. And you can see whenever rates come down, applications go up. When rates go up, applications go down. So you can't really see here over the last 10 days or so, we've seen some improvement in rates and already seeing an inflection up in applications, despite the fact that we're entering a slow part of the year. So Jeb, I got artistic on the chart that you and I looked at this morning. I wanted to show you guys this bigger wedge. So when we look back, when we're drawing these lines, you may sometimes see, if I'd only showed going back to October of 2023, you'd go, what in the world is that red line? So going way back to 2022 is where that trend line comes from. And we are now getting into a wedge pattern. So let's actually take a look here now that you can kind of see where that trend line is coming from back in 2022. Wanted to show that we don't necessarily go in a straight line, but when you see we have a downtrend in terms of the top of the channel, and we have an uptrend at the bottom. So we've been seeing higher lows and lower highs. So that's what that wedge pattern is. And it tells us at some point it's going to break out. But when we look at that, we have 10 days now of a downtrend in interest rates, and we will likely run down towards the bottom of that trend line and make a run up towards the top. But somewhere, Jeb, what did we figure? It was somewhere spring, like April, May,
June. Yeah. Second quarter.
That's when we're going to see showtime. I mean, could we get a breakout before then? You could. And it's important to look at, these charts aren't magic. It's not a crystal ball. You're not looking at it and going, oh, the charts themselves dictate what's going to happen, but it is magical how there is something fundamental that always shows up in the news that causes that action. Through this one in here, Jeb, you had mentioned it last week, but you couldn't remember where it was. We think we found the article that you were referencing, but Morgan Stanley is saying they expect the 10-year treasury to fall to 3.75 by mid-2025. And it's funny, whenever something like this comes up, people, oh, it's crazy. There's no reason for rates to drop. Well, just 2 months ago, 90 days ago, we were at 3.65. So that's their call. So their call would obviously be for a breakout of that wedge pennant pattern there to the downside. But we'll see. We'll see how that goes. In terms of interest rates, we're safely under 7%, 6.84 on the 30-year fixed, FHA and VA in the low sixes. And I can tell you that well-qualified borrowers well up into the 700s are getting rates a good bit better than this. So a nice improvement over the last few weeks. If you're in the market right now, less competition for buying properties, and you're getting some tailwinds from better interest rates.
Good stuff. Good stuff. So a lot of you guys out there are looking to refinance, looking to take advantage of rates as they move lower. Scanning that QR code, assuming you're not on your mobile, will take you to jebsmith.net/rate watch, which will ask you some basic information and get you on our list so that we can reach out. Team can reach out if and when mortgage rates get back down to a rate where it actually makes sense for you. That said, there's also a list of states, which is essentially the entire United States, where our team can help you. So if you're buying, selling, investing in real estate, want our guidance, the people that you're actually listening to here on the show, reach out. We'd love the opportunity to help. I think, I don't know what the number is, Josh, but every week, more and more people are reaching out and more opportunities. And I don't have the numbers. You might have the numbers of the number of people we're closing, but it's a good number. So a lot of people are reaching out. So thank you guys and for giving us the opportunity.
The number that we looked at earlier today, Jeb, I think was about 35 just since June, July. So second half of the year, about 35 of you have been able to either get a lower interest rate or get into a property. So we appreciate you for that.
Good stuff. If we can be of assistance, use that link scrolling at the bottom of the screen right now. And with that, Josh, let's take on some questions here. So we actually have a comment from someone we helped a couple years ago. Lupita. Lupe is here saying hello. So
did Lupe come and get a pie this year, Jeb?
She did not. She did not come. They were out of town. I forget where. Maybe it was I don't remember exactly. Maybe it was a birthday party. I don't remember. A lot of conversations, and they're all starting to kind of mix together there. So with that, what do we have? Great beard. I appreciate that. We have a lot of comments. A lot of comments, Josh.
Don, and I'm assuming it's Don, but it says Don and Bev Perkins.
Yeah.
Don or Bev says, do you have the same mortgage data for less than 4% and greater than 6%? I don't, because someone compiled that. The data is out there. FHFA tracks it. The ICE technology tracks it, but you would have to compile it from the raw data, and whoever put that together was focused on the 3 and the 6%.
Yeah. Obviously the 4%, there's gonna be more people under that 4%, right? Just because you take it up a little bit. But I will say there's more and more people now willing to give up the thing that they said they'd never give up, just because of life situations, like what we talk about all the time. What drives housing? Life events are what drive housing. With that, Josh, let me see here. We don't. We have some mortgage application questions, which doesn't pertain to the majority of our listeners. So I guess
No one has questions for us. We've answered, Jeb, what it is apparently is we've answered all of the questions. They are all educated home buyers and they don't have any more questions.
I feel like we've accomplished something. With that, I had like while we were doing this show, I almost thought to myself, we should do 2 shows. One show where we literally just do the first 20 minutes that we did right there and break it into its own show, where we just update you on what's happening in the economy weekly. It's not really a Q&A. It's just, hey, this is the information. And then also doing a full hour show, which is what we normally do, where we just do Q&A. So separate the two, if you will. But if we don't have questions, the second hour doesn't really help, or the second Q&A doesn't really help anything. So I assume we just keep it as is for now. Let's see here. It's, kind of a vague question, but can you share what some of the best investments to make as a first-time homeowner? I'm assuming you're talking about housing investments, is what I would guess you're asking about. Difficult question without knowing what you're buying, where you live, all that good things. But let's reframe the question a little bit, Josh, and say, what are the best investments you can make to your house for not necessarily an investment standpoint, but just for value long term?
I like to look at it this way. When you're thinking of maximizing the value of your home, you want it to be well-rounded. Like, you remember the kid in school who was a really good athlete, but he was dumb and he didn't dress well and he was antisocial. Well, that's not good. You kind of want to be all well-rounded. And kind of the example that I use, my mother-in-law is getting ready to redo her kitchen. Their home was built in 2004. Anyone that would walk into it would say, "It's a nice kitchen." It's not a 2024 kitchen. And for her, she wants the gourmet appliances. She wants the fancy cabinets and whatnot. And when we're looking at it, I say, who has just a nasty kitchen that anyone walks into and goes, "I don't want any part of this. I need a better, more modern kitchen." So for me, I want to look around and say, what's wrong with my house? What's the worst thing here? Maybe the windows have never been replaced and I have, single pane aluminum windows from the 70s. Okay, well, then that's going to get you a big benefit of someone having newer dual pane vinyl windows. Like, that's the stuff that I look at. I told you last week, your roof is about 24, 25 years into it. You don't really see it from the ground, but for me, that's probably the worst part of my house. So if I'm going to invest in my home, I'm going to go to a roof. So I don't think necessarily in terms of, kitchens and bathrooms are what people will say will get the biggest return, but if you start with a nice kitchen, you're going to get less of a return than someone else.
Yeah, I say focus on higher ticket items, things that not necessarily are the cosmetic things. Unfortunately, it's like buying tires for your car. Kind of sucks buying these things sometimes because you don't really see them every day or get the feeling of a new kitchen, a big island, the quartz countertops and all that stuff. But investing in things like HVAC and electrical panels and plumbing and roofs and water heaters, that sort of thing is that's what most home buyers are looking for in a property. They don't want to have to go in and spend a bunch of items replacing this stuff. On top of that, they do want kitchens and bathrooms and that sort of thing. But the problem with that is that trends change and designs change. And what I see is everybody at the moment is still doing the same things that were 5 to 6 years ago. And it's at the end of that. Like, that's not the trend so much anymore. And so those people are going to, not immediately, but at some point, that's not going to be the desirable thing. So focus on the things that don't necessarily change with time, because I think that's where you get the most value. Josh, let's see.
Lupe says you owe her a pie.
Listen, come pick it up, Jack. Come pick it up. Happy to buy you one. In fact, well, I tried to give Josh one, and by the time I got it to him, it was no longer good. It was a couple days old.
He brought me a hairy pie.
Yeah, it was not gonna be good by the time I got it to him. Question: do homes lose value if the owners smoked indoors? I would say, for the most part, the answer is yes. You're not necessarily going to lose value, but what you are going to do is limit your pool of buyers who are willing to consider that property. I've sold several properties in my career where they were heavily smoked in to the point where it was like I'm a non-smoker. It just like really, being in these properties is very difficult. And you just have people that walk in that just won't even consider it because of it. So you limit your buyer pool, which in turn probably limits demand, or definitely limits demand, and which limits the number of offers, value, all that good stuff. So it translates into that, but not directly. Now, am I being heard, Josh?
No, we can hear you. It was
Can
funny.
you not see me?
I cannot see you.
Yeah,
Your
my
camera.
browser has lost connection. Make sure you
You're.
have the right camera selected, it says.
We're gonna go with just Jeb is gonna be the voice of Oz today. You just
That's fine. Like, what is
Well,
going on here?
let me give my 2 cents in on. You popped back in there for a second. There you are. So, what I would say is, can it be resolved? So you guys know I've flipped a ton of houses, and it takes me back to a house that we bought in 2009. The husband died. The stepmom, which we bought from the kids, stepmom had a life estate. She got to live there for 20 years. She did no maintenance. She did smoke 2 to 4 packs of cigarettes a day, and every window in the house you could not see out of because it was yellow. That's how much it had been smoked in. And something to that extent, like it was pull drywall out, it was change cabinets. You were going to have to do some very significant things with that. There are other situations where you may be able to resolve it. I compare it, Jeb, almost like a house that had a cat that's peed everywhere. You come across those, and can you get it out? Yeah, but it's going to scare buyers enough that you're probably going to take a pretty healthy discount for the work that they're going to have to do and the uncertainty as to whether it's going to be successful.
No, agreed. I mean, I just sold a property, in fact, from someone here on YouTube, where the father of the seller had smoked in a bedroom for an extended period of time, and that was the only really room where it had it, but it was overpowering, and there were people that wouldn't consider the house because things on the property, but it was priced a little high to begin with. So didn't directly impact that, but it definitely impacted the number of people interested. So hopefully that's helpful. Kind of ran around with that one.
Jim, we got a question that I would like to hear your thoughts on. Midwest Workshop says, what are your thoughts about buying a home from HUD?
I don't really have any thoughts, Josh. I mean, it's not something we see a lot of out here in our market. Is there anything wrong with it? No, not that I'm aware of. They're back in the 09, 2010, 2011, 12. Some of the properties out here were HUD houses back then. Since then, I haven't encountered anything. So at the moment, I don't really have an opinion on it. Is there anything you want to add?
Well, at risk of sounding like, when your grandparents would tell you stories that sounded so just insane from their lifetime that you couldn't believe it. So at risk of sounding like that, in the 90s, when I started, the HUD list there was no internet, so it didn't get emailed out. It would get delivered to the office and printed, and you would pass it around the office and take a look at it. So in Orange County at that time, in LA County, lots of homes were still in that FHA price range, done FHA, and big list. We had $100 down condos, FHA condos. So from my perspective, it doesn't matter who you're buying from. You're going to do an inspection. You're going to be aware of what you're walking into. It's definitely a little bit different in terms of negotiating. Will they do any repairs? I haven't dealt with one in so long that I believe for the most part, they're telling you it's as is. And what they generally would do is if there was anything that would prevent someone from getting financing, they would fix that before they listed it. Jeb, you used to work with Fannie and Freddie in terms of liquidating bank-owned properties. And was that pretty much what they would do, get them to a minimum lendable standard and try and get a financed offer?
Yeah, I would say the majority of properties that we had were financeable to begin with. But typically what they would do is try to get the most bang for their buck out of that property. And so what that meant was me going out and getting bids from people on paint, carpet, that sort of thing, just to get it nice and quote unquote shiny for the new buyer. And most of the time it made sense. Put, 5, 10, 15 grand into these properties and, just be able to sell it for whatever the going rate was at that time. And Yeah, they would do it most of the time without having to do anything. New appliances, and there were different incentives back then, and it was a different market, a different environment entirely for many reasons. But it was fun. It was fun until you had to float all the cash for keys and all the bills and stuff, and you would have like 30. I was on the smaller side, and some of these people had hundreds of properties. I had like 30 something properties. At one point, we had to pay the cash for keys for the tenant, and they would reimburse us. Well, the reimbursement was like a 90-day period of time, and so you had like a ton of money out at one point between paying for utility bills and people moving out and all this crazy stuff. But anyhow, yeah, hopefully we don't have to go through that again.
So Midwest Workshop follows up with, wasn't sure if you dealt with them. We have a few in my area that are not priced bad. From my perspective, it is just another seller. If you can get a good deal and it's a property you like and a good location, absolutely no reason to shy away from it. Just know the limitations and the differences of dealing with that type of a property.
Yeah, and at the end of the day, if there's less demand on them, I mean, those people, those like HUD wants to sell those properties. They don't want to hang on to them. So there might be a reason, a reason for negotiation, a bigger negotiation from their side. So hopefully that helps. All right. Good idea to buy a duplex with tenants. What should I look out for before signing a contract? So I would say yes and no. If you're buying a duplex and the market rents are there, they're already paying market rent, it could be a good deal, assuming everything else on the property makes sense and all that stuff. When it's hard to validate it is when the rents aren't they're not performing at market rent, if you will, because at least in the way that California works, it's very difficult to get those markets up to where they should be because of all the laws in place. Very tenant-friendly state. So in some cases, yes. In some cases, no. But if and when you do decide to do that, just make sure that you see the payment history of the tenants. Like you have some idea of the people that you're going into contract with as tenants if they're staying in place, so that you're not getting yourself in a position where, hey, these people haven't, maybe they're current now, but in the past they've had a history of not making their payments on time or something that's not ideal. In fact, I have a 4-unit property in Santa Ana that I manage for a client, and I would say 3 of the rents are at market rent. 1 is not, and even though it increases every year, the max you can increase in that area is like 3%. And so it will never, I mean, it's a couple $100 away from being a market rent. And the reality is those people probably aren't leaving, because to go find something similar is going to be considerably more. So, and there's no way to get them out of the property. Even now, Josh, I saw something recently where that if you were doing like the remodel thing, then you could validate, asking a tenant to leave and whatever. I think now that's it's either off the table or becoming something that's going to be passed, where you can't even kick them out now if you're going to remodel the property. It's not even an option anymore.
And this is largely what tenants don't understand about rent control, restrictions, limitations on landlords. You think you want that, but and there are people that do. They want the landlord to subsidize their housing, and it doesn't matter. But I can tell you, I own a 4-plex in Long Beach, and it's doesn't have full-blown rent control, but they're very tenant friendly there. And what happens is, even if I want to keep a tenant at a below market rate rent, there's always that specter hanging over our head that there will be rent control and there will be bigger limitations put in place. So as a landlord, it is important to me to keep within a very narrow distance of what the market rents are, even if I have a tenant that is awesome and I want them to stay there. Because when you get too far away, you're very difficult. You're never going to get it back to where it is or where it should be. And you may find yourself with a tenant that will never leave because they're so far away. They know that you'll never be able to get them to a market rent.
Agreed. Midwest Workshop, $5 super chat. Thank you for that. I appreciate your hospitality there. Very nice. Very grateful for that. Josh,
Thanksgiving was last week, Jeff. So more
still grateful. Can I not be grateful? Let's see. Manuel says, considering buying in the Bay Area due to good opportunities, what are your thoughts on high cost areas? No different than any other area. Depending on where in the Bay Area, the Bay Area's had bigger issues than some of the other areas that are higher cost because of politics and certain people in place. And driving out businesses, and just there's a whole thing going on. So I don't know if you're talking specifically San Francisco or whatever areas, but sometimes the opportunity is an opportunity because of a reason. So just be careful when you're looking at certain markets, thinking, okay, prices are significantly less now than they were a couple of years ago. I should buy now because they're down. Well, they might be down because of something bigger going on. And San Francisco is one of those markets that's experienced that. And at some point it will come back. Things will get cleaned up, and things will, it's kind of like New York in the 90s. And now where New York is, it's probably something similar where things will change over time. But the question is when and what happens between now and then. So it's not an easily solvable problem, unfortunately.
Saying this doesn't mean as much as it used to, because we aren't in 2005 when everyone was putting their entire 401k into the NASDAQ. But I compare the Bay Area. It's more like tech stock. It has done very, very well over time, probably outperformed in terms of annual appreciation Southern California, but it's more volatile. You get more and bigger dips, and then it'll rip back up. So as long as you have a long time horizon, you're probably going to do really well.
No, agreed. Let's see. Well, Oracle Park, a below market rate. Yeah, I don't know specifically where that is, so that doesn't help me. Josh, we have a listener that's currently at 2.503%. Never seen that one before. On a 30-year fixed. They've outgrown the home and really need to upgrade. Do I sell and buy, or do a HELOC and expand?
More goes into it than just the numbers, but start with the numbers, plug it into a spreadsheet. When you say, okay, if I'm going to move, this is what my new house is going to cost. If I'm going to sell, this is what I'm going to net. So here's my new loan. Here's my new property taxes. Here's new homeowners insurance. What does that look like? So total all-in PITI payment to total all-in PITI payment on the current loan plus the HELOC. Probably going to be much cheaper to stay where you're at, but there are just issues where houses have limitations. You can't do anything to them. You don't have an unlimited budget in terms of renovation, so it may just not work for what you want or need. But if it's a floor plan and a lot where you could do an addition that makes sense, a HELOC can make a heck of a lot of sense for adding on and making it work. I mean, just straight off the top, you're going to have 4 to 6% selling costs to sell that property, and that money is just gone, non-productive whatsoever. So when you factor in the subsidy from having that ultra low interest rate and going to a current market rate, if you can make it make sense and the house is well suited for the improvements you want to make, I would lean towards staying.
Yeah, I think the thing to do is to go and see what it costs to buy what you need in a house. What is that going to run you? Monthly payment wise, is that going to use up all the equity that you have in your current house? Do you have the money? All of those things, and then compare it to what is it going to cost to add on, and how much square footage, and then do the two, right? A home equity line, with today's rates, depending on how much you're pulling out, and how much you currently have financed at 2.5%, it may not be that big of a difference at the end of the day. So that's what you kind of have to run a couple of different scenarios to see what makes sense. But in a state like California where property taxes stay low, if you're in a state like California, then it's a lot of times it makes more sense to build if the opportunity is there, because you're able to keep some of the other costs low. Whereas moving and paying higher property taxes, like for me, that was the biggest, downside to buying a bigger house when I decided to do it, was that I bought my first property so low, and now my property tax is going to be 3 times what they were. That's hard to swallow sometimes. So I think you got some comparison to do. And if it's even close, then, it might just be easier to move. And that way you're not dealing with being there with a remodel and all that good stuff. All right. Josh, let's see here. Fixed on going new construction. How do I find an agent? I feel like approaching a new build alone, but I know it might be good to show up with an agent. Reach out. Siete. Happy to refer you to somebody I know in the area. They can walk you through it. And have a conversation. So that honestly, that's the easiest route. Use that referral link below, reach out, and I'm happy to put you in touch, assuming I know somebody in that area, but we haven't gotten an area yet that I don't know someone or ask someone that can help. But the other opportunity, if you don't want to do that, is find somebody that's had a good experience and use them as as a reference point to find somebody in your market. Here's what I'll say. Most people think they don't need an agent on new construction. A friend of mine here locally posted a video probably a week or two ago. I lost track of time because of the Thanksgiving and what have you. And she showing her client's property as they walk through it, and there's blue tape. You should see, because her and her client got to go through with tape and mark things that needed to be addressed. The amount of blue tape in that property. And the best part was, she said that at some point in the property, the builder's representative got like pissed and frustrated at the process because there was so much blue tape that he asked for his tape back and told them they needed to use their own tape. And so the color changes. It goes from blue to another color because they had to go use their own tape for the property. But the amount of things that were wrong, that's why having a separate person is good. And at the end of the day, the builder, I would almost assume is paying for their compensation. So you should be good to go to get your own representation.
And if you're in one of those areas that has a lot of new construction, hopefully it's an agent that's familiar with all of them. Because a lot of times if you just walk into a sales office, hey, I like this location, I like this floor plan, I like this model, or I heard something about this builder, you don't know the relative differences. Like if you're in the Inland Empire and you're looking in a specific city, there might be 5 or 6 new developments you could buy in, and each one of them has their relative merits, and an agent can be very helpful, different from a sales agent telling you the great things about their property. They can compare and contrast the pros and cons of each one.
Good stuff. Night Panda, $10 super chat. So thank you for that. For the contribution.
Bro, you're not just getting the $9.99. I got a question. You better answer it.
Where do you see it? Hit it up.
Night Panda says, what are your thoughts on the market for vacation homes in 2025? And by the way, it's confusing me that the Night Panda has a cat for an avatar. If you're going to be the Night Panda, there better be a panda in the avatar, or at least a black and white cat.
Maybe like their cat's name is Panda.
I at least want a cat that looks like a panda.
You do. You're overanalyzing this whole thing. Thoughts on the market for vacation homes in 2025? I think overall the vacation home market is probably slowing down just compared to where things were during the pandemic. There are still markets out there that are going to be hot, where you can still do VRBOs and Airbnbs and that sort of thing. Those markets are still doing fairly well. I mean, we're going up to Mammoth for Christmas with another family, and it's incredible what we paid for 4 days there in one of these places. But nevertheless, markets like, for example, local to where we are, this might not mean something. Lake Arrowhead is now a market that has a lot of inventory, right? A lot of these people bought during the pandemic, realized that, I'm probably not going to use this thing quite as much as I used to. Plus insurance costs has gone up because of fire. All of these different things kind of added into it. And people are going, I probably don't need this. So there are markets like that are going to slow down even more. But I also think there are markets where things will continue to do well. Mammoth being one of them. Lake Havasu, like some of these markets where, it just didn't really not really getting hit by insurance and some of these other things, I think are probably still strong markets. But overall, I think it's a slowing. And, depending on what happens in the overall market, some people might need to get rid of these properties, especially if zoning changes with short-term rentals and that sort of thing. Anything you want to add, Josh?
And again, you will probably want to reach through and punch me, but in terms of buying anything, I like to buy when it's advantageous as a buyer. So Jeb's correct that it's moving better in many of those markets where there's more inventory, where you can get a much better deal than buying 2-3 years ago. But like, I bought my place in Rancho Mirage. We paid $265 for it in 2010. The next door neighbor sold for $549. Someone did probably $150,000 renovation on it and just sold it for $950. You're like, what are we talking about? At $950, like, I don't think I would have a vacation condo out there, but we own it with my in-laws and we use it a ton. And when it's split up that way, very, very reasonable. But even split with all of us at 950, it's a different animal. And you had talked very importantly, Jeb, about can you monetize it with Airbnb or VRBO? Where we are in Rancho Mirage, when we bought it for the first several years, you could do overnight rentals, any length. Now it's 28 days or more. And when you look at that, we don't want it tied up for 28 days. We want to use it. And the rate that you get for 28-day or more rentals is much less than for someone wanting to come in for 7 to 10 days, like you're going for Christmas. So it doesn't mean no one should ever buy a vacation home, but it's just a very, very different market than it was, 7 to 10 years ago.
Agreed. Josh, we got someone here. Whoa. Who says, do you use Matterport? I do. I'd use it on all listings for 3D tours and that sort of thing. It's way less cumbersome than it used to be in processing and that sort of thing, and can do floor plans and all that good stuff now. But you probably know that if you're asking the question. But yeah, I do.
Night Panda confirmed that is their cat.
That is the cat. That is the cat. Well, nice to see your cat. Josh, what do we have? We have been on.
We got an early night off. 15 minutes to go, and no one has any more questions.
Well, here's a question. Same. Whoa, asked earlier. What's age range of buyers currently? So we've always been on the show saying that the millennial years just because they're the most people turning prime buying age, which has typically been about 33 years old. That's historically what's been prime buying age. I think what we recently found out, Josh, and you can correct me if I'm wrong, I remember something saying that the average age now is about 38 years old for a first-time home buyer. So the average age is getting older, but I would say that most of my clients personally are somewhere between that 30 and probably early 40 age for buyers. So it fits that demographic that we've been talking about. Nationwide, it's going to change. California is different, right? Prices are higher. You need longer job stability, bigger down payments, all of these things that typically take a little bit longer to get. So the age is probably going to be a little bit older rather. Whereas, areas where the cost is less, it's probably going to be, a lower age, but it's about 30% or so of the market is still first-time home buyers at the moment. So you still have a pretty good chunk of people buying their first home, about a third of them. So that's it. That's all I got, Josh.
Well, we got more questions. Jeb, I'm going to tee you up with a very easy one because the answer is wait till Tuesday. Christian wants to know, will Trump's plan to impose tariffs cause home prices to increase, especially new builds, and how will that impact resales?
Well, actually, I'll do you one better, Josh. So Christian, Josh and I filmed an episode on the podcast, which is The Educated Home Buyer, separate from this channel, about 3 weeks ago. In fact, if you go over to the Educated Home Buyer channel and look at, I think it's something like these Trump policies will have an impact on house prices, something like that, or on the housing market. We go over the entire thing. So go over there and check it out. But this coming Tuesday, we actually recorded it today. We do a similar episode, but we talk about how it impacts mortgage rates. So 2 episodes, very similar in who we're talking about, but a little bit different in what we're talking about. So the Educated Home Buyer podcast channel, if you haven't done so already, we just hit almost 5,200 subscribers on that channel, Josh. We started it 2 years ago. So thank you for all the support over there. But the easy answer is maybe on your question. There's some unknowns in there, but we discuss it all in detail. Probably too much to do right here.
I do not believe we're going to get anything resembling what he has talked about. He's walking around with a big stick and threatening to thunk people on the head with it. No one wants to get thunked on the head. I do not believe it will happen quite the way he's proposing.
That's an interesting way to look at it, Josh. KL, I have $70,000. Should I buy land and build a modular home or buy a home new or resale? Very tough question. Kind of 2 different things entirely. You have to look at buying land and building modular. What does it cost to do that? I'm assuming $70,000 isn't going to get you both in that world. So, what does the financing look like on that? Kind of a lot goes into it there. Other thing to consider is that modular, mobile, manufactured, all of those things don't typically appreciate as well or hold value as well as a new or resale property. So depending on what your goals are and how long you plan to have that property, you got to think about some of the other things. It's probably going to be more expensive to buy new and resell than it is the other. But buying land and building isn't as easy as people want to make it out to be. Especially
or is cheap. Oftentimes they go, oh, it's
yes.
cheaper. I can do this because this is the cost of the modular. This is the cost of the land. It's cheaper.
Yeah. So I would say it's a more in-depth question than we can probably get onto than we can get into on the show. So hopefully that gives you a little bit of guidance, but I would consider all sides of it. Stephen rather had a comment earlier, but I think it's a good comment because it's something that you and I have talked about, Josh, and it just says, I don't know where interest rates are headed, or I don't know where interest rates are going, rather, up or down. Regardless, I am buying now because of less competition. So you and I we're talking the other day off camera, and just talking about it. And I said, Josh, I've never had a time in my life where I bought a property where buying that property depended on something that was going to happen in the future on whatever said property we were talking about. It was all, does it make sense now based off where I am in my life, where rates are, where the payment is, rather, does it all make sense? Whether it was an investment property or something to live in, it was always that. I was never going, you know what, I'm going to wait and buy this house when interest rates go down, or I'm going to wait and buy this house when house prices go down. Now, in some cases, maybe I should have done that, right? 2006, I should have done that. But reality is, prices, if you held on, prices are higher now than they were then. So the answer is always have a longer term time horizon in doing this. And there's probably no issue at all whatsoever. But Josh, is that the right way to look at it? Is it, do it because there's less competition, or do it because now is better for one reason, or is there a waiting period for some reason?
Let's say with what we've started and I've always said, buy when it's the right time in your life. So if you in today have concluded career, savings, credit, relationship, ability and willingness to stay in one area says it's time to buy, we have the chart. I can dig it out here somewhere that shows that the vast majority of the appreciation happens between like April and August. So if you're going to do something, we've seen over the last couple of years a range of rates between 6 and 8%. We've hit the bottom a couple of times. We've almost hit that top a couple of times. So there's opportunity in there if you get in at the high end. We had 18, 20 listeners in October and November able to roll down from a 7.5 to a 6.25, something along those lines. So you're going to have that opportunity. But most projections, and we're going to do for the podcast, we're going to do an episode of our projections for next year, both in terms of interest rates and home price appreciation, are still projecting 3 to 5% appreciation next year. If that's what we get, we're going to get 70% of that within that 4 or 5 month window. So right now, you get ahead of next year's appreciation, less competition. If you're in an area where there's weather, it could be a significantly amount less competition. So start with that. Is it the right time for me to buy? And if it's the right time for me to buy, I wouldn't be the person waiting till spring. You may not find the right house. You may wait till spring regardless, but get out there and see what's available now.
Agreed. Yeah, just do some. Like I'm going on Bigger Pockets tomorrow, and on Bigger Pockets, we're actually going to do an episode where we basically go over other people's videos, title, thumbnail, and what they're talking about in the video, and we get to talk about it. And it's going to be fun because the reality is most of these people that have been, in fact, all of them that I'm aware of that have been crashers to begin with and or become crashers because it pays to become a crasher, have been significantly wrong about everything. And so can you wait? Can you wait for a better opportunity? You can always wait. Will it come? Possibly at some point. But the reality is, what happens between now and then? What is the goal of it? Is it for you and your family? There's so many different things that play in it. And I think the problem now with social media and Zillow and Redfin and just so much data, quote unquote, data available, is that it's just noise. It's noise in the big picture, and it skews the reason that people want housing to begin with, or for the most people want housing to begin with. Yes, there's investments, and those should be analyzed differently than a single family home that you're buying for your family to live in, or a condo that you're buying for your family to live on. So don't take, the advice is a little bit different if you're buying for an investment purpose or something else. But at the end of the day, it's buying when it's right for you. And that's as simple as it gets. And you shouldn't worry about what other people think or, their opinion. And if you're asking here if you should buy or wait, then you shouldn't be buying. I mean, that's the reality. So anyhow, Josh, do we think, I mean, I know you said this, we can now, do you think there's a chance that interest rates go sub 6% next year?
Is there a chance, or has absolutely a chance? We hit 365 a few months back on the 10-year. We saw one of the investment houses there saying 375. To get under 6%, all it takes is a 375 with a 2.21 to 2 spread to treasuries, which, if we see that moderation, we'll see servicing values increase, more competition, see the spreads come back down. So absolutely possible. I don't know if I would predict it, but I would say a reasonable range for next year is say 5.5 to 7. I think the top being up there from 7 to 8%, like we've seen it hit both in 23 and 24. I think that's behind us. I'm tempting my fate there by saying that, but I think that's behind us, which would also lead me to believe that there's a new lower low ahead of us. But remember, it's always important to point out, I feel bad in the mortgage business because my clients, and therefore me and my business, we're vultures. We're rooting for bad economic news. So be careful what you wish for. If we get a 5.5 or a 5% mortgage rate, it's because the economy is doing poorly, that unemployment went from 4% to 6.5, 7%. So just be careful. It could be you that's that 2.5, 3% increase in the unemployment rate when you were saying, oh, I need this to happen so I can get a lower interest rate. And it turns out you're out of a job and not able to take advantage of it. So, I would love for them to go lower, but I would like to see a slow grind back to normal where maybe we have a 5.5% unemployment rate. We get inflation at 2.1, 2.2. So you have strong GDP growth at 3% plus, and we kind of have this Goldilocks where maybe we have a 5% interest rate with not too high or too low of unemployment and inflation approximating that 2% that the Fed wants to see.
Good stuff. We had this question earlier. I'm throwing it in there because we're kind of lacking in questions, but it says, I have a 3.6% FHA. What would be a good interest rate worth refinancing? So if you have a 3.6 FHA, chances are the mortgage insurance is probably 0.85, Josh, just because of where rates were back then, might be off. But either way, if it's 0.85%, you're sitting at basically 4.5% on your interest rate. You need interest rates to probably go 4.25, 4, even lower. And well, maybe if you can get it, if you can get a conventional loan, it would probably have to be there. Now, if it's another FHA loan, then this isn't even worth discussing at this point.
No, we get this question all the time, Jeb, from people that FHA buyers, for some reason, are just incredibly upset that they have mortgage insurance. Just tell yourself it's not mortgage insurance, and I don't have a 3.6 interest rate. It's 4.15 or it's 4.45, depending on what your mortgage insurance is. And until you see rates below that, you pat yourself on the back and say, hey, my cost of funds for financing my shelter is much better than what most people have.
Yeah. And anytime anybody says something crappy about an FHA loan, you just laugh because you have a 4.5% interest rate where they're financing at 6.5, 7%. So with that, there's a lot of people out there buying, selling, refinancing, asking questions to us on here. And a lot of times we get people coming in at the last minute. They're already under contract. They're trying to get a second quote. Something went wrong, didn't work out for one reason or another. Start your journey with us. There's a referral link in the description of this video where you can talk to the team here and guide you through the process. And then, you can get a second quote from there, but at least have the conversation now so that you're not doing it at the 23rd and a half hour, trying to make your deal close, and because it happens too often. So use us as a resource. With that said, there's a referral link scroll on the bottom of the video now where you can get in touch with us. Josh, anything you want to say tonight before we say adios?
No, nothing really to add other than do you figure out where you're at, what you want to do. When the time is right, you'll know. Like Jeb said, if you're one of the minority of folks here in that 10% that's asking about vacation homes, asking about investment properties, you're going to analyze that very differently than someone saying, I'm going to buy my house. You're going to look at it like Jeb said, I bought because it was the right time for me to buy a house. I wasn't looking at it primarily as an investment. Over a long time horizon, it will be an investment and it will do well for you. Even if you bought at the absolute worst day in the last 20 years, it would have done well for you over a 15-year time frame. So from that perspective, do you know your situation? Buy when it is right for you. Don't let anyone pressure you to not buy, to do anything crazy, to buy too much. Do you.
All right. With that, guys.